Walgreens Boots Alliance, the drugstore chain we all know, is stepping away from the spotlight of public trading, and a deal valued at a staggering $24 billion. This marks the end of an era for Walgreens, a company that's been publicly traded since 1927, when it celebrated the opening of its 100th store in Chicago. But what prompted this significant shift? Well, the agreement with Sycamore Partners, a private equity firm with a keen eye for consumer and retail businesses. It involves a cash payment of $11.45 per share. Now, this represents an 8% premium over Walgreens' closing stock price, but there's an added bonus for shareholders, the potential to receive an extra $3 per share from future sales of Walgreens' ventures into primary care. These include familiar names like Village Medical Summit Health and CityMD. You might be wondering why Walgreens chose this path. To understand that, we need to look at the challenges they've been facing, a real perfect storm, if you will. The post-COVID landscape has been tough on everyone, and Walgreens is no exception. They've had to grapple with shrinking reimbursements for prescriptions, cautious consumer spending, and a venture into the healthcare sector that hasn't quite lived up to expectations. Going private offers them a chance to breathe, to step back from the relentless scrutiny of public markets, and implement changes with more flexibility. This could potentially be the key to revitalizing their business. And speaking of revitalization, Sycamore Partners firmly believes that Walgreens' pharmacy-centric model is vital for driving better healthcare outcomes for both patients and communities. With their proven track record of successful retail turnarounds, Sycamore Partners aims to leverage its expertise to get Walgreens back on track. However, the road ahead isn't going to be easy. Over the past 5 years, Walgreens' stock has plummeted by almost 80%. Back in 2015, their market value soared above $100 billion, but by late 2024, it had dwindled to a mere $8 billion. That's a significant drop, and it reflects the intense competition they've been facing from all sides. CVS grocery chains, big box stores, and even online giant Amazon have all been chipping away at Walgreens' market share. To counter this, Walgreens has been proactively closing stores to bolster their bottom line. They're planning to shutter around 1,200 stores over the next 3 years, with 5 other closures slated for fiscal year 2025 alone. To put that into perspective, Walgreens currently operates around 8,700 stores across the United States. That means roughly 1 in 7 Walgreens locations will be shutting its doors by 2027. This is a stark reminder of the changing dynamics in the retail pharmacy sector. These recent closures mark a significant intensification of a trend that began in June 2024. Back then, under the leadership of CEO Tim Wentworth, Walgreens announced the closure of 300 underperforming locations as part of a multi-year optimization program. At the time, they revealed that roughly a quarter of their stores were operating at a loss, hinting at imminent changes to address this issue. This move to close stores might seem drastic, but it's a reflection of the challenges Walgreens is facing from all sides. One key factor is the intense competition from industry giants like Amazon. The online retail behemoth has disrupted countless industries, and the pharmacy sector is no exception. Amazon's entry into the prescription drug market, coupled with lower reimbursement rates for prescription drugs, has put a significant dent in Walgreens' profits. This trend is affecting other drugstore chains as well. Experts in the field have weighed in on Walgreens' situation, offering insightful perspectives. Neil Saunders, the managing director of Global Data, suggests that selling Walgreens to a private equity firm could be a strategic move to extract value for investors. He believes Sycamore Partners, the acquiring firm, might consider selling off the UK chain Boots as a way to maximize their return. Saunders acknowledges the magnitude of the task ahead, stating that Walgreens is a big company with big problems, and this would be a longer-term investment rather than a way to make a quick buck. He emphasizes that while cuts would most certainly be on the agenda, the path to growth would be challenging due to the inherent problems of the healthcare, pharmacy, and retail sectors. Another expert, Tyler Guesty, the director of healthcare M&A at the consulting firm West Monroe, highlights a strategic misstep by Walgreens. Unlike its competitors, Walgreens failed to strategically align with the payer, which could have helped them bridge the gap between their pharmacy and healthcare segments. CVS, on the other hand, successfully executed this strategy by acquiring health insurer Aetna in 2018. Guesting points out that instead of forging such partnerships, Walgreens invested heavily in acquisitions like Clinic's VillageMD, which required major investments in real estate technology and skilled labor. He predicts that now there will be strong interest in Walgreens' healthcare assets. Given the increasing focus on value-based care and cost management in the industry, this assessment reflects the shifting priorities in the healthcare sector, where cost-effectiveness and integrated care models are gaining traction. But Walgreens' challenges extend beyond the pharmacy counter. The front ends of their stores, where they sell snacks, household staples, and other convenience items, are also feeling the heat from larger competitors. Big box retailers like Target and even dollar stores like Dollar General are putting pressure on Walgreens' ability to compete in this space. Dollar General's expansion, particularly in rural areas, has further eroded Walgreens' market share. This competitive pressure on multiple fronts underscores the need for a comprehensive and well-defined strategy to ensure Walgreens' future success. It's clear that Walgreens is at a crossroads, facing internal and external pressures that demand decisive action. Their decision to go private is a bold move, a gamble that could either revitalize the company or hasten its decline. Only time will tell if this strategic shift will be the key to their resurgence. This transition transition back to private ownership raises a number of critical questions. Can Sycamore Partners, with its experience in retail turnarounds, breathe new life into this iconic drugstore chain? What strategic shifts will be necessary to navigate the ever-evolving healthcare landscape and fend off intense competition from rivals like CVS grocery chains, big box retailers, and online giants like Amazon? Will Sycamore Partners, as some experts predict, divest the UK chain Boops to unlock value and streamline operations, allowing them to focus on revitalizing the core Walgreens business in the United States? But perhaps most importantly, how will this transition impact Walgreens' vast workforce and the communities they serve? Will store closures lead to job losses and reduced access to essential pharmacy services in certain areas? These are complex questions with no easy answers. The future of Walgreens remains uncertain, but this move marks a pivotal chapter in their long and storied history. It's a chapter that will be closely watched by investors, industry analysts, healthcare professionals, and of course the millions of customers who rely on their services every day. As we conclude our deep dive into Walgreens' decision to go private, remember to like and subscribe for more in-depth explorations of fascinating topics like this. This situation really underscores a larger trend we're seeing in the retail pharmacy landscape. Both Walgreens and its competitor Rite Aid have been shutting down hundreds of stores across the country in a desperate bid to shore up their dwindling profits. This wave of closures highlights the immense pressure these once thriving chains are facing. From declining prescription reimbursements, it's a tough pill to swallow, to say the least. Let's take a closer look at Walgreens' plan to streamline its operations. Back in October, they announced their intention to close roughly 1,200 stores over the next 3 years. That's a significant number, signaling a clear commitment to restructuring. In the fiscal year 2025 alone, they're aiming to close 500 stores. To put that into perspective, Walgreens currently operates around 8,700 stores across the United States. That means roughly 1 in 7 Walgreens locations will be shutting its doors by 2027. This is a stark reminder of the changing dynamics in the retail pharmacy sector. These recent closures mark a significant intensification of a trend that began in June 2024. Back then, under the leadership of CEO Tim Wentworth, Walgreens announced the closure of 300 underperforming locations as part of a multi-year optimization program. At the time, they revealed that roughly a quarter of their stores were operating at a loss, hinting at imminent changes to address this issue. This move to close stores might seem drastic, but it's a reflection of the challenges Walgreens is facing from all sides. One key factor is the intense competition from industry giants like Amazon. The online retail behemoth has disrupted countless industries, and the pharmacy sector is no exception. Amazon's entry into the prescription drug market, coupled with lower reimbursement rates for prescription drugs, has put a significant dent in Walgreens' profits. This trend is affecting other drugstore chains as well. Experts in the field have weighed in on Walgreens' situation, offering insightful perspectives. Neil Saunders, the managing director of Global Data, suggests that selling Walgreens to a private equity firm could be a strategic move to extract value for investors. He believes Sycamore Partners, the acquiring firm, might consider selling off the UK chain Boots as a way to maximize their return. Saunders acknowledges the magnitude of the task ahead, stating that Walgreens is a big company with big problems, and this would be a longer-term investment rather than a way to make a quick buck. He emphasizes that while cuts would most certainly be on the agenda, the path to growth would be challenging due to the inherent problems in the healthcare, pharmacy, and retail sectors. Another expert, Tyler Geisting, the director of healthcare M&A at the consulting firm West Monroe, highlights a strategic misstep by Walgreens. Unlike its competitors, Walgreens failed to strategically align with the payer, which could have helped them bridge the gap between their pharmacy and healthcare segments. CVS, on the other hand, successfully executed this strategy by acquiring health insurer Aetna in 2018. Geisting points out that instead of forging such partnerships, Walgreens invested heavily in acquisitions like Clinics Village MD, which required major investments in real estate technology and skilled labor. He predicts that now there will be strong interest in Walgreens' healthcare assets, given the increasing focus on value-based care and cost management in the industry. His assessment reflects the shifting priorities in the healthcare sector, where cost-effectiveness and integrated care models are gaining traction. But Walgreens' challenges extend beyond the pharmacy counter. The front ends of their stores, where they sell snacks, household staples, and other convenience items, are also feeling the heat from larger competitors. Big box retailers like Target and even dollar stores like Dollar General are putting pressure on Walgreens' ability to compete in this space. Dollar General's expansion, particularly in rural areas, has further eroded Walgreens' market share. This competitive pressure on multiple fronts, it really underscores the need for a comprehensive and well-defined strategy to ensure Walgreens' future success. It's clear that Walgreens is at a crossroads, facing internal and external pressures that demand decisive action. The decision to go private is a bold move, a gamble that could either revitalize the company or hasten its decline. Only time will tell if this strategic shift will be the key to their resurgence. This transition back to private ownership raises a number of critical questions. Can Sycamore Partners, with its experience in retail turnarounds, breathe new life into this iconic drugstore chain? What strategic shifts will be necessary to navigate the ever-evolving healthcare landscape and fend off intense competition from rivals like CVS grocery chains, big box retailers, and online giants like Amazon? Will Sycamore Partners, as some experts predict, divest the UK chain Boots to unlock value and streamline operations, allowing them to focus on revitalizing the core Walgreens business in the United States? And perhaps most importantly, how will this transition impact Walgreens' vast workforce and the communities they serve? Will store closures lead to job losses and reduced access to essential pharmacy services in certain areas? These are complex questions with no easy answers. The future of Walgreens remains uncertain, but this move marks a pivotal chapter in their long and storied history. It's a chapter that will be closely watched by investors, industry analysts, pharmacists, healthcare professionals, and of course the millions of customers who rely on their services every day. So as we wrap up our deep dive into Walgreens' decision to go private, it leaves us with a lot to think about. What does this mean for the future of the retail pharmacy industry? How will this impact consumers and access to healthcare? These are important questions that we'll continue to explore. Be sure to like and subscribe for more deep dives into fascinating topics like this.